Inheritance tax, often abbreviated as IHT, is the tax the government takes from the estate of someone who has died. Your estate is everything you own, including property, savings, and possessions such as artwork, jewelry, or cars. The standard inheritance tax rate is 40%, and this is what the government will take after you have deducted any tax-free thresholds or reliefs. Your spouse or civil partner takes all your estate tax-free up to your threshold limits on your death. But be careful if you are giving assets to children in your will, as this may impact your spouse's later levels of tax relief. Currently, your tax-free threshold is £325,000, so that amount is deducted before tax. So, if your estate is worth £525,000 and your inheritance tax threshold is £325,000, the tax charged will be on £200,000. The tax would be £80,000, which is 40% of £200,000. If you own a home and pass it on to children, then you also have a further relief of £175,000. This is called the residential nil rate band. Together, you have a potential total of £500,000 for a single person, or potentially £1 million for a couple. But be careful, this is not a simple £500,000 or £1 million deduction. It is only when homes are being passed to children and grandchildren, and you know it gets complicated if you are giving other parts of your estate to other members of the family or non-family members. The residential nil rate ban does not apply to second homes, business properties, or holiday homes. If you have more than £2 million in assets, your estate will find that your inheritance tax relief allowances are reduced by £2 for every pound. So you really need to carefully plan your estate to reduce your 40% tax liabilities. Talk to LifePartnerWills for more expert advice on inheritance tax and how to mitigate your liabilities through careful planning and trusts.